So, good afternoon to everyone. Let me welcome all the participants to today's webinar on impact of ELC provision on NBFCs, and none other than the expert CA Charanjit Atra is going to help us, talk to us, and take us through the whole presentation. We also have today CA Lalit Bajaj, Chairman WIRC with us, and Regional Council Member CA Vikas Jain. So may I now request Chairman WIRC CA Lalit Bajaj to give his opening remark. Lalit bhai, over to you.
Thanks, Murtaja bhai. Welcome all participants. Speaker of the session, Charanjit Singh Atra, partner EY. I think the subject which is kept today is apt as far as the present financial year ending is concerned. And this is very specific. So I would not touch upon the subject of the today's technical session. I would request our speaker sir to take the session and cover the area of today's session in such a way that our participants get the maximum insight on the subject. As far as mode of the seminars being conducted at WIRC via webinar, I think so way ahead. This is the way we are going to have many of our seminars in future. And as far as current lockdown is concerned, we have planned multiple programs in this way. And I would request all the participants that if you feel so there is any relevant subject wherein we should keep a webinar, please suggest us, please mail to us at wirc@ici.in. One more thing just to share with you. Since yesterday, we have started with the webinars for articles and students. The idea behind that is that articles and students are the backbone for the parallelly for the profession and for the practicing unit wherever they are doing their articleship. So the whole idea behind this is the best way they can perform services to the firm's clients by sitting at home, and at the same time to get the best of the education which they can get. I request all of you chartered accountants to convey this message to your article students and all your known students to please join in the webinar for students. The timing is most probably fixed for the next 4 or 5 days, which starts at 2 o'clock in afternoon. So comfortably they can join. So please request them and try them that they are part of the webinar. As far as other things at ICI and WIRC is concerned, one thing which I wanted to convey to you was we have started with a help desk at WIRC just to channelize all the issues and concerns and queries of members and students and forcefully take it ahead with ICI and resolve it at the earliest. At the WIRC website, you will find the link of help desk. Please post your query there. We will ensure to help you out at the earliest. We have come out some days back with a e-publication on key audit matters, which is very much relevant as far as the audit season and the reporting season is concerned. I request all of you, you can visit the e-publication because we have come out with a search engine wherein we have compiled audit reports of somewhere around 200 plus balance sheet, and we have come out with around 1,000 cases wherein there will be some insight on the way in which we can report on a particular issue or on a particular area. As far as education is concerned, you all must be knowing, I would like to share once again with you is, we have a digital hub at ICI wherein we allow members and students to come and get knowledge on whichever area they look forward. The only idea behind that is that we should not be left alone whenever we want to get some knowledge on a particular subject. And we have tried to create a whole library of subjects and lectures, most of the areas wherein so that a member can reach out to the hub and get the best of the information which he can. And we are in the process of uplifting and including more areas in the library. In the near days, you will find many more things on the digital hub. Sir, lastly, I would like to convey a great thanks and congratulations to each one of you for being so gracious and generous in coming ahead and contributing to COVID-19 purpose. Let me share with you that we have already crossed a general contribution of 4 crore odd amount. We have crossed that figure. And as you all know, we have contributed 15 crores from our kitty. I think so. We are left short of around 1.5 to 1.7 crores. I request all of you, whoever have any intention to do it, please help us and do it at the earliest. I think so. This is what, as a chairman, I wanted to convey to each one of you. And thank you for being part of this webinar and guiding and enlightening us that how we have to take ahead the education at WIRC. And believe me, we all at WIRC or my regional councils are with an utmost interest to do our best as far as sharing knowledge with all our members is concerned. Thank you. Thank you, Murtuji bhai. Back to you.
Thank you, Chairman, for your opening remarks. And yes, I will also request everyone to contribute to the COVID fund, which we can again, the ICI can contribute to the PM Care Fund, and it can be utilized for this purpose now. With that, let me now request our Regional Council member, CA Vikas Jain, to introduce today's speaker. Vikas bhai, over to you.
Thank you, Musa bhai. Today's expert faculty, Charanjit ji, Dynamic Chairman and Secretary of WIRC, Lalit bhai Bajaj and Murtuza bhai. All the participants, a very good evening to all of you. I welcome you all. Friends, Lalit bhai has said rightly that yes, WIRC is taking wonderful initiative under his leadership and with the able support of Murtuza bhai and all the team. And I request you all to take the maximum benefit of the same. And for COVID, yes, we all must contribute generously. At the same time, I request you all to please exercise the social distancing, which is very much important. In Ahmedabad also, we have been seeing in Mumbai for so many days, the cases are increasing like anything. So yes, we need to take care of that. Now let me come to the task which has been assigned to me to introduce our today's expert faculty, CA Charanjit Atra. He is a chartered accountant and CPA from the US, specializing in financial services. Presently, he is working on IFRS and Ind AS conversion for banks, insurance companies, and other financial institutions in India. He has been nominated on various committees of the Institute of Chartered Accountants of India, Reserve Bank of India. He is also a special invitee to the National Advisory Committee of the Accounting Standards set up in the Ministry of the Corporate Affairs. He has worked with ICICI Bank Group for more than 12 years. He has a great experience with him. He has received the Best CFO Award for 4 years by the CFO Institute. He has also been rewarded by the ICI as the for the contribution in the financial. With this brief introduction, I present before you our today's expert faculty, Charanjit ji. Charanjit ji, over to you, please.
Thank you so much, Vikashi, and thank you to Mr. Lalit Bidaj and Murtuza for giving me an opportunity to speak to all of you on this. Just to introduce myself, I've been with Ernst & Young as a partner for the past 5 years now, and then my basic role has been assisting large banks and NBFCs and insurance companies in sort of getting themselves ready for Ind AS reporting. And as you know, the Ind AS reporting for NBFCs have already started. Some of the NBFCs have already reported numbers under Ind AS last year, and some of them will be required to report this year. So it becomes very critical to assess, what would be the impact on certain, impact on particularly ECL. Now, before I reach to ECL, I would like to, sort of pause for a moment and think, why are we discussing this and why is it becoming so important? So if you look at purely, I think one has to look at the impact in three sort of different phases. The first phase is obviously, as our honorable chairman was talking about, and Murtuza and spoke about was on the COVID-19, which is the spread of the pandemic through coronavirus. Now, once that has happened, it has impacted on the businesses of various companies. Most of these companies either borrow from NBFCs or banks. Now, the question is, once they have been impacted, the same things will have to, sort of be in a way captured while provisioning, because under index what is required under the expected credit loss is to provide for the expected credit loss on the day of reporting and not on the actual loss which has happened. So one expected credit loss anyway as a concept provided or required entities to look into the future and find out what were the probability of default and the loss given default for particular borrowers. Now that itself, after the entire coronavirus thing has stepped in, it has impacted various businesses, and to further sort of hit it. This close downs, the lockdowns which are happening across in India as well as abroad have impacted the functions of the company. So one really doesn't know whether this lockdowns or this close down. As today, there have been news in the past couple of days that this sort of this lockdown might get extended, which would mean it would have another significant impact on the industry, particularly on the manufacturing units who could be the borrowers of these NBFCs. And if it extends, one really doesn't know. The plants have shut down. There'll be a cost of shutting down. There'll be a cost of restarting. Who will bear that cost? What happens to that companies? Now, generally, well, when people did their ECL models for the last year or for the year before last when they reported, they would have actually considered a lot of historical data while arriving. Even their segmentation of the portfolio, or to an extent, finding out the probability of default and bucketing, the staging, was more predominantly based on historical data. But fortunately, unfortunately, after this event happened, and this event had happened in the last 2 months of the year, the historical data will not reflect the problem that have happened. So how does one go and compute the ECL? And that is what we will, sort of discuss in this session. And let me tell you, this 1.5 hours or 2 hours may not be sufficient to discuss the entire impact and how do you sort of get a solution to the problem caused by COVID-19 on the computation of the expected credit loss. However, we will try to cover and see at least what approach NBFC should follow and how could we as accountants and auditors look at that approach and satisfy ourselves on whether the approach is correct. So what we'll do first, we'll look at what is the impact, what are the challenges that are going to be faced, what are the areas of concern on particularly ECL, and then see what are the likely approach that we need to follow. And based on that, every entity, every person will have to take a different call based on what they perceive as the future risk in that borrower or in that group of borrowers that they want to analyze. Also, if you look at globally, there have been a lot of regulators of different countries who have come out with certain guidelines on how to do IFRS 9 assessment. We will look at those guidelines in the session also on what are the guidelines and how those guidelines can be used when we do our own approach. Our own regulator, which is the Reserve Bank of India, has issued two circulars in the month of March. One circular was issued on 13 March, which required NBFCs to do a particular set of things while computing ECL. And the second circular which came was on March 27th, 2020, in which actually gave some moratorium or relief to the lending institutions based on the COVID-19 impact. So we look at what these two circulars bring in, and how do we then go ahead and see how do we assess the expected credit loss for individual companies, and how do the companies do it for themselves. Once we discuss this, then we discuss very briefly on what could be the auditor's considerations. What would auditors look at? and how would auditors gain comfort on the entire approach followed by companies. For people who are attending now and who have not been well acquainted with the ECL approach, let me just dwell on it a little bit to explain that the expected credit loss approach is was the approach which was stated in Indes 109 section 5. If we go through it, talks about the entire expected credit loss approach. It was a big shift from the actual loss approach that we did, or the expect actual losses that we booked, or the percentage loss based provision that we made based on the RBI norms. Typically, this India's 109 required losses to be created based on future forecast. And actually, it says it was based on probability weighted cash flows expected from a borrower. Now, this is what the statement used in the standard, which said probability weighted approach. So, which would mean if you have to put into a formula, your expected credit loss is nothing but your exposure multiplied by a probability of default multiplied by a loss given default and discount that. So all this taken together gives the expected credit loss. So actually, you had to go into the estimating of future cash flows and creating a provision. There was also a lot of discussion on how those future cash flows needed to be created, and it was always felt that past data or historical data I could actually provide an insight into the future. But again, as I said earlier, fortunately or fortunately, the incident which has happened now on COVID-19 is unprecedented. It has never happened in the past. And that's why there is no historical data which could give you what's going to happen in the future and what sort of losses have been, sort of incurred by various NBFCs or banks who have lent money to various sectors. Given that as a context, let's look at how do we, sort of meet up to that challenge? How do we sort of estimate the an appropriate expected credit loss models, and how, as auditors, we get comfort on the approach used by various entities? So, what I have done here in this slide is actually listed down all areas which are areas of concern which could impact the capitals and earnings of a company. In all my future references in this session to a company would necessarily be to an NBFC and related companies. Now, though in this session we are going to discuss only about expected credit loss, but there are other areas also which might get impacted and which we could cover separately. Uh, from that, why expected loss, credit loss will get highly impacted is primarily because there has been a lot of vulnerability of the assumptions used for computing ECL. This impact, I mean, this COVID-19 and the long taken along with lockdowns has actually thrown out, various of the assumptions out of the window. Those assumptions may or may not hold true for the future. So all those assumptions that we have used for calculating the ECL in the past will have to be retested and revisited. Unless we retest and revisit them, it to adopt them as it is may not be the correct thing to do. Further, again, we see what is happening in the economy. GDP estimates have come down. The markets have taken a big hit to come down. The interest rate, the yields are following. So typically, all your macroeconomic factors have changed. And if any company had considered any macroeconomic factors in the past while determining the ECL provision, they would have to look at the basis of those macroeconomic factors and whether they changes. The other thing, point which I want to make is on staging. Staging would mean actually if you classify a loan in stage one, you use only a 12-month expected credit loss model, whereas if you classify the loan in stage two, you would sort of classify the same or compute the ECL on a lifetime expected credit loss model. Now today there could be instances where it is very difficult to sort of figure out whether it is stage one or a stage two. Given the fact, and we'll discuss the RBI measures which have been taken, which have given some concessions to the lenders, and people have got moratorium to repay loans. that would also go in effect whether you want to create a 12-month ECL versus a lifetime ECL. Also, while computing LGD, one takes into consideration the collections that a company is going to make from sale or sale of collateral. But looking at the impact, the collateral values could have also have declined. Now, we all know the issues of real estate sector just before COVID-19. The real estate sector was any which way going through a lot of turmoil. Post COVID-19, I think that will still going to get aggravated, which would mean that the value of the collateral offered by the borrowers would get significantly hit. So I believe that one will have, while computing the LGDs, one will have to also take a slightly higher haircuts while determining what could be the realizability. So and also because of the lockdown shutdown, the questions will really arising whether the stocks which were kept as security or as collateral are in the book debts which are kept, do they really exist, or they would have been used by now or spoiled by now, and it may not be possible by the time of the financial statements to actually go and do a physical verification to figure out whether the stocks really exist. So, given all these challenges, computation of ECL becomes a great concern, and we need to sort of find a solution to this, or at least an approach that we are going to follow to compute ECL. In my discussions with most of the companies, I work with a lot of companies who compute ECL. They have been raising these concerns, but to an extent of to solve those concerns, I think there have been a lot of regulatory actions. So before we actually go and look at this, all these factors individually and independently, let us discuss for a brief while what has happened on the regulatory side, both in India and globally. So if you look at the key regulations in India, there have been a lot of concessions given to the companies. Uh, Sorry, the Securities and Exchange Board of India, they have extended the time for filing of your Q4 financials, and now the new deadline is June 30th. That will give companies some breathing time to actually work on the financial statements, including the disclosures. The CARO, which was to be applicable from the current year, has also been deferred from for a year or so. And I believe that would also go in a long way to sort of help companies or give them the breathing time to prepare financial statements. Also, as I told you earlier, Reserve Bank of India has come out with a message on March 27th, 2020, clarifying certain things what the companies need to follow. What the March 13, 2020 circular did, and that was just at the time when COVID-19 had started and we didn't know what is going to be the impact of COVID-19. At that point in time, the Reserve Bank of India put certain additional controls within the companies to ensure that various changes in the parameters, assumptions, and other aspects of the ECL model are approved by the senior most body, which is the audit committee and the board of these companies, and not as the management, which was done earlier. So effectively, for the year ending March 2020, all the entire ECL approach will have to be approved by the audit committee board. And if there are any changes from what was adopted or disclosed in the previous report, previous financial statements, will have to be approved by the audit committee or board. I believe this would bring strong internal controls into the system, and this is one good measure which has been taken by the Reserve Bank of India. The other aspect which the Reserve Bank of India brought in was creation of a prudential floor, which meant that these companies will have to compute provisions as per the ECL model and as per the income recognition and asset classification norms of the Reserve Bank of India. Uh, and in case the provisions as per the RBI norms are higher than the ECL provisions, the difference between the two will have to be taken to an impairment reserve. I believe that would help in creating some questions for future provision, and in future, RBI might allow using the impairment reserve. As of now, RBI has issued no guideline on utilizing. So once an amount is transferred to the impairment reserve, it will still remain in impairment reserve. The other thing that this circular brought about was on the capital front. It actually allowed NBFCs and basically the NBFCs to consider the excess of the fair value of the property, plant, and equipment over their cost at about 55 to the extent of 55% as tier to capital. Now, these step would definitely boost the capital adequacy requirements of the NBFCs. Further, it brought about certain operational sort of flexibility where it allowed companies to disclose and report certain ratios on index numbers, which earlier there was no requirement for them to do. There was no clarification, and the companies were reporting in both India's as well as Indian GAAP number. Now it's positive for the industry. After that, the entire COVID-19 impact happened, and the RBI
The speaker has a bad connection, is joining in again. Just hold for a minute.
Hello, sorry, I got disconnected and I'm back now. Murtuza, can you hear me now?
Yes, we can hear you. Yes, we lost you in between,
Yeah,
but
sorry,
now it
Mike,
is very
there was
clear.
some connection.
Sure.
Yeah, thank you so much. So, uh, RBI came out with a regulatory package on COVID-19 on March 27, 2020, under which it granted a 3-month moratorium on payment of installments of term loan outstanding. It also said that the interest on working capital facilities to be deferred by 3 months. It further said that such measures need not result into asset classification downgrade. And also, it's further said that the rescheduling of payments will not qualify as default for the purpose of supervisory reporting and reporting to credit information companies. Now, look at what's happening. There has been an impact which has been caused by COVID-19, and there are some relief measures which are coming in. Now, while computing ECL, one has to look at both. Now, how do you look at both? For example, there were questions raised or challenges raised if a borrower was in default on say 1st of March 2020 by 60 days, and on the 90th day it is a moratorium given. Will that account be treated as a stage 3 account or a stage 2 account? Further, if somebody was overdue for a 0 day or say 10 days as of 1st of March and now it takes a moratorium, will it be treated at stage 2 or stage 3? All this confusion started coming, and this sort of moratorium, or what it is called globally as payment holidays, hasn't only happened in India, but it has happened across the globe. So a lot of global entities came up with guidance on what needs to be done. Various regulators like the International Accounting Standard Boards, the European Central Bank, and everything have issued guidance on accounting implications of the COVID-19 outbreak, and more specifically on the calculation of expected credit loss as per IFRS 9. Now, as we know, IFRS 9 and Ind AS 109 are very, very similar. And I think they are mostly the same except for one carve-out which doesn't even impact ECL and which is not in the area of ECL. So when we are discussing ECL, any references to IFRS 9 or Ind AS 109 is the same. Now, the International Accounting Board clearly said that IFRS 9 is a principle-based standards and is not set on any bright lines or a mechanical approach for determining lifetime losses. And what it said that the entities will have to apply the existing ECL methodology, looking into both the aspects, the payment holidays as well as the what they called as the economic shock. What it said further that please don't mechanically apply ECL provision. Though there is a formula which is being used, don't apply it as a rule. Don't just say, look at your past data until unless the past data you really believe it is representative of the future. Don't use the result some of them into your into your determination of what is significant increase in credit risk while you are doing staging. The 30 days past due, or the 90 days past due sort of presumptions can be rebutted in this scenario, and one should look at clearly rebutting that. If you really ask me today, I don't believe that number of days criteria would be a sufficient criteria to determine staging at this point in time. As you all know, while determining expected credit loss, staging is very critical. And any loan which passes on from stage 1 to stage 2 has to be based on significant increase in credit risk. The standard does provide for sort of a backdrop to say, if you have nothing, 30 days past due or days past due could be considered as a significant increase in credit risk. But in this scenarios, given that there are many payment holidays and the the borrowers won't pay, will not necessarily mean that it's a significant increase in credit risk can you classify to stage 2. Now, given this background by the ISB, the question really arises in front of us is saying, how do we do staging? The first step initially is to do staging, then calculate the probability of default, calculate the loss given default, and then arrive at a provisioning number. But itself at the first stage, in staging when there have been payment holidays or the moratorium given, how would we determine what case is where it is a significant increase in credit risk, where it is not? Various other regulators came up with other guidelines. Now, these guidelines again are principle-based guidelines and not rules. So we need to draw analogies from them. We need to draw principles from them to apply in our own circumstances. So what this global regulator said, they said that the company should develop estimates based on the best available information about past events, current conditions, and forecast of economic conditions. We should mean, if you look at in Indian circumstances, we should look at what happened in 2008, 2009 times. What are the impact at that point in time? If we have the data, then maybe look at the other time when there was like sort of a temporary shutdown was during the note ban, and we should actually see during that period what were the losses, particularly in case of some loans, and whether we can, derive some numbers from there. Also, the global regulator said that while making forecast, the company needs to consider nature of the economic shock and the impact that the economic support and relief measures, including debt moratoria, will have on the credit risk of the expected life of the instruments or the expected life or the balance, what we call the duration of the loan given to the borrowers, which would change from system to system. So what actually all this, if I have to sum up into a sort of one line or one sentence of what global guidance all about. It said, look at loan by loan, look at what data you have, look at how it has been impacted, look at the industries which has been impacted. In fact, one of the European central regulator has gone ahead to say that it may not be possible to calculate the impact of ECL on borrow by borrower, but it may be possible to find out which industry or which sectors, maybe based on geography or location, has an impact of COVID-19. And in spite of the relief measures, this relief could be just temporary, and there could be significant increase in credit risk in those areas. And particularly for those sectors and areas, consider lifetime expected credit loss instead of a 12-month credit loss, which would mean that you classify those sectors, those areas, those industries into stage one to stage two. For example, if in a portfolio of a company you have exposures to say the airline industry or the real estate industry or the hotel industry, which would have a significant impact. And if we believe that in spite of the moratorium given, these companies would get significantly impacted in the long term, one should consider categorizing them in stage two rather than stage one. And that is what is coming out. And also we spoke about, we thought about when we were doing ECL earlier, of creating a management overlay. And this is one of the times when a management overlay might be required, because at present, even the global regulators feel there would be no single model or no model which could appropriately capture all that what is happening. So one would have to create a management overlay which would consider a management overlay even after determining the amount of provisions. Now, this is guidance. Uh, Sorry, I'm back. So, hello, can you hear me? Okay, I think the audio connection will reduce and be restored. So, what I was talking about is, on the management overlay. And once the management overlay has been done, I think we would be able to get to the most likely impact of ECL. Also, at this point in time, since there will be annual financial statements also coming out, disclosures would play a very, very critical role, because the users of financial statement, particularly the investors, would like to know how have we considered the economic shock of COVID-19 while estimating ECL along with the relief measures. So not only the numbers but the disclosures become very, very critically important when we are talking about ECL, and that itself becomes very critical. So after looking at all this global guidance, regulatory impact, and what the economic shock of COVID-19 has been, let us now go and discuss how do we actually practically compute the impact on expected credit loss. So if you look at the key aspects of the expected credit loss, those are, if you look at in the diagram on your screens, it is the significant increase in credit risk, the exposure at default, the macroeconomic factors, the loss given default, and the PD, which is the probability of default, and to sum it all, the disclosures. Why I have kept disclosure at the top is because finally at the end of the day, all these factors, assumptions, numbers are going to go into your disclosures, and disclosures become very, very critical. And we all know, for all of us who have worked on disclosures of NBFCs, that disclosures are really complex and long and require a lot of computational hazard. The other thing, if you see in the diagram, I put regulatory considerations at the center. As of now, there has been a lot of global guidance on what is done to be done on IFRS 9. Well, there has been very little guidance from RBI on this aspect. In the future, we could have some guidance from RBI on this. We have to keep ourselves tight in that and be aware of what's happening on the RBI side. We will try and come back to you if there is something on RBI coming coming up, and we'll have to take that guidance also while estimating expenses. The staging challenge that we are going to face is that the basis of staging based on the DPD status of borrowers will not be entirely representative because the incident has happened, as I said, in the last few months, and none of the past data. This is totally unprecedented, and none of the past data is going to even capture the impact of this analysis. And even if we sort of look at the RBI circular of March 13th, it only spoke about prudential for even under RBI guidelines, you won't see the actual defaults happening. So to that extent, the 30-day DPD or the DPD status will not be helpful. The other thing is there have been moratorium given to borrowers, which would again mean that even if you take the days past due and the borrower is in moratorium for the month of March and April, you will still find that it makes no sense because the moratorium has been used. So there may not be a significant increase in credit risk, but some of the borrowers might have just used it as an amount of working capital and they might repay it in June and July. And if you looked at the global guidance, they have also said that please consider both and don't consider just because somebody has used a payment holiday that it has degraded from stage one to stage two. So those are the challenges that you're going to sort of face in determining staging. In my view, particularly, the likely approach that the companies have to follow is to identify the borrower level risk and early warning signals framework, which ideally have to mean, as I said earlier, one if one breaks up the portfolio into two parts. One is a sort of portfolio which has been impacted by COVID-19, and the other portfolio which has not been impacted by COVID-19. For the portfolio which has not been impacted by COVID-19, we could use the staging criteria which was given by past historical data because that is going to be applied for them. Within the portfolio which has been impacted by COVID-19, now how do you find out that portfolio? I think this is the time where robust risk management procedures will help. One will have to actually get into this and do it completely and go into loan by loan, maybe where there are large loans for smaller loans, group them into various industries, geographies, locations, and figure out whether they've been impacted. And within the impacted areas, one will have to actually see break it up into further two categories where they have used moratorium and where they have not used moratorium. In the cases where the borrower has not used moratorium, one will have to just look at the credit risk and say whether there are other any aspects which have permanently, sort of impacted the company and if whether there would be any long-term loss. But areas where the borrowers have used moratorium, one will have to be very clear and we have to be very decisive in saying whether it is a temporary relief or it is a significant increase in credit risk. And based on the information available to them, one will have to actually determine this thing. Going to be difficult, not easy, but these are testing times, and one will have to use a lot of assumptions and lot of forecast in this. For example, there could be cases where borrowers for which rating was already deteriorated or was in difficulty before the outbreak, where you could say this borrowers there has been a significant increase in credit risk, and irrespective of the COVID shock or the relief measures given, this would have anyway gone into stage two. So those borrowers will have to be taken in stage two, and really wherever borrowers have used the moratorium, one will have to identify whether these are really temporary reliefs and they would come out of it post this temporary relief gets over, or it is a significant increase in credit risk. So the approach to be followed clearly is break up the portfolio, take a top-down approach, identify areas, sectors, geographies where you feel it has been impacted, and look at them differently. Look at factors other than the past due criteria to identify whether there is a significant increase in credit risk. And this can happen only through strengthening the risk management procedures and looking at certain other factors, getting more information on the borrowers, so forth and so on. Exposure at default would mean the outstanding amount that you take for computing provisions. I think from an NBFC perspective, this couldn't be a challenge because most of the undrawn limits or the confirmed sanctions would have been utilized by now, and that will automatically come into EAD. If they have not, and some credit conversion factors are being looked into, I think the company should revisit the credit conversion factors and maybe be a little bit conservative on that side to say whether this will be utilized or not utilized, and what is the commitment or the actual obligation of the company to these borrowers, whether they come now and they'll be, sort of sanctioning them the new facility. So that would be very critical to determine. But generally, I believe from an EAD perspective, the challenges will be lesser. The only thing that NBFC will have to do is to look at revisit their credit conversion factors. The next part and the most, I think, the difficult part in this entire exercise during these times is going to be determination of probability of default. And as I've discussed earlier, the challenges on the computation of PD is basically one, again, historical experiences may not be representative because COVID-19 has is unprecedented. Further, after the outbreak, the chances of the corporate portfolio ratings being redone are very less. So how do you figure out, sort of what is the correct PD for a particular loan or a particular group of loans? Now, according to me, again, the likely approach should be as follows. On large exposures and credit impaired, which is NPA loans, we need to measure ECL on them individually depending upon whatever information is available, and what is the current status, the industry which to they belong, so forth and so on. For the other cases which are smaller in size, one needs to, determine the ratings and PDs on a collective basis, such as industry, location, and maybe resegment some of their portfolio into risk characteristics based on geography, which is the countries or regions most impacted, and countrywide support measures, industry, more severe or more lasting impact of virus is expected on travel, hospitality, entertainment, and service industries. Supply and demand change analysis. I mean, those industries which are into supply and demand change, which could have stopped working. And over and above the normal PDs that we arrive based on this analysis, one should consist of management overlays because I know it is not possible to sort of include the impact of COVID-19 in your PD computation in any model that you use. So again, a top-down approach, look into say resegment of portfolio. And again, if you read this along with the March 13 guideline of RBI, any approach that we're going to use, whether it's for PD or whether it is for SIACR, will have to be approved by the audit committee and the board. This makes it very, very critical now for us to come to a position to say this measurement now is going to be of a different level. Now, the question clearly one may ask, or it may arise in your mind, is to say, are we expecting any RBI guidelines on this? Is our regulator going to provide some sort of, this thing? The answer to that is still a big question mark. We don't know, but we are just waiting for it. As if the RBI comes up with the guidelines, we will have to follow the guidelines. If it doesn't, then this is the approach this is the likely approach I think should follow. There could be better approaches, but one will have to sort of look at, try to look at case by case as much as practically possible, and then, assess the impact of COVID-19 on the probability of default based on resegmentation of the portfolio. The next part, the last part which I'd say in determining ECL is the loss given default. I think again the impact of COVID-19 on the values of collateral will have to be considered. Example, shares or bond prices, real estate values, and the credit standing of any guarantor. And haircut percentages may need to be revisited on the basis of the nature of collaterals, as the past experience of recovery from collaterals may not be completely reflected. And also the actual collection process would undergo change because of the shutdown. Your collector or the recovery people will not be able to go and recover the amounts of all from, and that sometimes will delay recoveries, and delay recoveries, and accordingly the recovery rate, which would mean a higher LGD. So to that extent, one will have to consider that while determining the LDG. Having done that, one more thing which is required by the standard is the macroeconomic scenarios. Until today, macroeconomic scenarios will mean all the assumptions after you have made, what would be the change in the assumptions if the macroeconomic position will change. In the last 3 months, we have changed a drastic change in some of the macroeconomic parameters. The normal relationships of macroeconomic factors with credit risk parameters now may not be reliable, especially due to the government and regulatory interventions, which change the economic behavior of the markets. We'll have to consider epidemic, risk of future outbreaks, nature of steady state, and will the long-term rate of growth be low? So all this, today one will have to determine. So, and it can be clearly seen that there is no consensus on the future, and even today, as we are talking about, there is no sort of vaccine created for this virus, and we really didn't don't know when the world is going to open up for business to be as usual. So one will have to take a long-term impact of macroeconomic factors into it, and maybe even when you are sort of doing a management overlay, you'll have to consider this. You need to have some economic forecast. I think most of the large companies would have an economist who would do this. But this is going to be a challenge in the macroeconomic factors, and I would believe one will have to sort of look at it very, very minutely, and will also look at further guidance of what the global regulators are giving and what the RBI is going to give on this. But in absence of any guidance, I would believe considering, to consider a management overlay for macroeconomic factors, and that could be an appropriate. But this all needs to be documented in a policy document, which needs to get approved by your audit committee and the board of directors. So this was on the computation of expected credit loss. There will be a lot of disclosures which will be required after computation of the expected credit losses. Given the inherent level of uncertainty and sensitivity of judgments and estimates, disclosures of key assumptions used and judgment in made in estimating the expected credit losses would be very important. This would include how and to what extent the effect of COVID-19 have been factored in, your estimates of SICR, ECL, forward-looking information that we just discussed some time back. I would actually point out certain pointers on which disclosures will be required, which is listed there on your screen, which says, the values of the key macroeconomic inputs used in multiple economic scenario analysis, the probability weights for the scenarios, the assumptions used to determine the different challenges for specific sectors and regions, effect of management overlays, nature of any material reliefs offered to the borrowers, including those enforced by governments, whether they result in a substantial modification of the contract, the effect on staging and impact of overall ECL. All these factors will have to be, sort of considered when you're making the disclosures on the financial statements. I think there are two sort of challenges. One is when you actually compute the expected credit losses, and two is when you actually, making the disclosures. So to sum it up, I would actually say that while computing the expected credit loss, use a top-down approach. Try to look at your individual large cases separately. See whether there has been an impact of COVID-19 and whether there is a significant increase in credit risk for individually. For your other smaller portfolio, resegment the portfolio on the basis of changes in credit risk and try to figure out what is the impact of COVID on that. For areas which are not impacted, you can still use your standard PDs and LGDs. But the areas which have been impacted, consider which classifiers will actually fall into stage two and apply a lifetime set of PD for that. After doing all those that you do in the model, consider management overlay over and above that if you think that the provisions are not this thing. Factor in the macroeconomic factors in the management overlay and have some extra provisioning there. I mean, I'm very sure something else will come up there. uh, and particularly for cases which are showing significant increase in credit risk, evaluate the lifetime PD. It's very, very critical, I think, to have this provision, because if there is a major sort of, I would say, error in identifying a provision now, it would come in the next quarter or maybe the next 6 months, and which will be difficult to explain. So one has to be very, very focused on this. Consider higher haircuts on collaterals. That becomes very, very critical because that one, there has been decline in the value, and two, there is going to be increased time taken to collect this collaterals. So while estimating the ECL, one will have to consider higher haircut, uh, pay proper attention on disclosures. The users of financial statements are going to look at how have we factored COVID-19 and all that happens. So disclosures will also be very, very critical on doing this. Uh, to last to conclude, saying that given that modeling assumptions and methodologies that prevail in normal times may prove inappropriate in the current context of extraordinary uncertainty, it appears of paramount importance that companies pay attention to the governance framework, adjustments, and overlays that will prove necessary going forward. So basically, this comes from the fact that whatever you do, whatever assumptions you're using, and also the RBI requires it, will have to go through a proper governance mechanism where all levels have looked into it and signed off on the approach that you used. And coming to the last but not the least slide which I have on audit consideration, how would auditors look at it? I mean, some of you must be auditors, some of you must be working in companies, and sort of you would be considering, what auditors look at. In my view, auditors would rely on management assessment. Auditors would require the companies to demonstrate the objectivity of the entire approach and the governance framework along with risk management strategies of the company. Uh, when I speak about the governance framework, I actually mean to say the auditors will look at whether the approach and the systems that you've used have really been approved by the senior most or the highest authority in the company, and has been applied in the right way as approved by the audit committee and the board of directors. And management should also consider providing justifications on every assumptions used, and the justifications should be strong justifications based on sort of analysis they have done of the past and future, particularly of the future, and provide proper justifications for auditors to rely on. Uh, the auditors, if are not comfortable, can look at two things. One could be on a general disclaimer saying, given the complexities in the calculations, they could sort of give a disclaimer or actually make it as a matter of emphasis. So to avoid that, it is very critical for us to say that look at that we provide proper justifications for all the assumptions that we have used while computing the expected credit losses. We put in a proper governance framework, put in proper processes, so forth and so on. Look at what's happening around the globe, what is the various global authority saying, because as I said earlier, IFRS 9 and Ind AS 109, at least as far as it pertains to ECL, are exactly the same. There are no carve outs there, and we need to be very focused on it. And I really don't know at this point in time when I'm talking to you, when I actually work with the companies, what are the other challenges that we're going to face while computing the expected credit loss. But whatever challenges that I have come across when I've been speaking to various companies, what I've just discussed with you, and I think there is a way of handling it. And even the globally, if you talk about the regulators speaking about it, they are asking for an assessment based on a collective basis to say, at least an industry for, the three, four industries that we mentioned, whether it is the aviation industry, the hospitality industry, or some industry, some companies in the services sector, which could get highly impacted. We should actually be able to carve them out and compute specific provisions for them, and cover them with good internal processes, good internal controls, good governance processes, so that we avoid qualification or even a mentor or emphasis in the audit reports. Having said that, the impact of COVID is not going to be on only expected credit loss matters, but also on other related matters, which we listed down in the first slide, which range from your investments, the business models of classification to even the going concern assumption. So one will have to create proper justification on going concern assumptions and so forth and so on. So I would, suggest to take proper care, do proper segmentation, use a lot of data. I understand given this times, getting data would be, very, very difficult, and we are all working from, remote locations. So it will be very difficult to get on a good, sort of data, but that is a requirement, and we would have to do it. There is no option. We have got some, sort of extension from the reserve, the SEBI, and the other regulators, some waivers, so that we can, use it to the best of our ability sometime. And I sincerely hope that, we get over this crisis far, so that we can come back to our offices and work. These are going to be testing and trying times, and we need to sort of take care. I strongly believe TVS chartered accounts, and spoke about this yesterday also. We have stood up to all such situations and combated them and come up successfully. I'm very sure this challenge is also posed on financial accounting and reporting. We all will sort of come over it and tide over it. It's just a matter of time on what we need to do. So that ends up my presentation. I've tried to sum up all these things into the short period of time I had, but we could sort of discuss this to the end. Happy to take any questions that you may have on this. I know you would have very questions. I would, in the whatever time that is left from now, I would like to answer a couple of questions which you would have asked by now. And thank you so much. Sorry. So I've got a list of questions here with me,
Yes.
and I will just read out the questions while the document is opening up. So the first question that I have is any comparative to a table for loan interest and repayment provisioning under IRAC norms vis-a-vis Ind AS. I don't think so. There is any comparative table for loan interest and repayment provisioning. I think there have been a lot of questions asked on whether we should compare this on a loan by loan basis or on an overall basis. And my answer to that would be one should go to the lowest level based on the information available and the way provisioning it is done. But as of now, as we speak about, there is no table which is available. Hope that answers the question. The other question was how the impact due to COVID-19 will be taken into consideration while computing the ECL provision, and also how it will affect the policy of the company on ECL provision. I think I have discussed that in the entire presentation on how individual factors will get impacted. The policy will company will have to change, and they will have to actually go back to their audit committee and board due to the March 13 circular on what policy they need to adopt. In my view, the likely approach to this should be more of a top-bottom approach. Identify the top borrowers, figure out what is the incremental impact of COVID-19 on them. For other small loans, do a collective basis, figure out on a collective basis what could be an impact for industries which are severely impacted. Consider doing a lifetime provisioning as compared to uh, a 12-month provisioning and so forth and so on. So I believe that you know would be what needs to be done. The other question that we have here is what is the impact of COVID-19 on ECL provisioning? I think we just discussed that. I think COVID-19 will have a substantial impact. There are certain borrowings to the real estate sector. There are certain borrowings to the sectors which are under stress. And once that happens, it's going to be significantly impacted. I would not be surprised if the provisions increase by a significant amount. And that's why one has to be very, very articulate and clear when this thing is being done. Uh, Again, the next question was methodology for computation of PD and LGD for SIR cases for wholesale lending. I think again the answer is the same for wholesale lending. Do industry-wise segmentation uh, for cases which are significantly impacted or which are impacted by uh, COVID-19 one, and along with the relief measures, if you really feel that this is not temporary relief and this will impact this thing in a longer way or in a large way, one has to consider increment provisioning and consider, in my view, to consider incremental provisioning is to consider lifetime provisioning instead of a 12-month provisioning, which would mean you classify those loans which you think have significantly increased in credit risk to stage two and provide higher provisions, and that is how actually it will help in arriving at a more appropriate number. However, whatever you do needs to be approved by the audit committee, and I'm making this again and again because I strongly believe that the audit fraternity, and some of you who are in the audit fraternity, are going to look at the approach set up by the apex body to sort of get comfort on these numbers. Uh, I believe the other ways to look at would also, if possible, and I think that could be very difficult, if in the COVID scenario you could re-rate the wholesale portfolio. It may be possible from mid-size or small-size NBFCs where there would be less than, say, 20, 30 corporate loan. They could re-rate those loans and look at their ratings and then consider the normal PDs. But for large NBFCs and all, it becomes very difficult. It will be very difficult given the timeline given to re-rate the entire portfolio. The ideal scenario would be to re-rate the entire portfolio based on COVID-19 and apply, whether we need to apply uh, 12-month PD or a lifetime PD. But I think well, that's going to be practically impossible. So it's better to look at the top 50 cases separate, top 20 or 50 cases separately, and the balance are based on collective provisioning. The next question which I have is saying if a loan was at 61 days past due on 1st March and the loans have to be given moratorium as per RBI circular, would the loan be classified as stage 3 on 31st March 2020? Very interesting question, and this question has been asked to me many times. The answer to this and my view on this is as follows, is to say that any loan which needs to be classified as stage 3 is where it is very doubtful of recovery or it has defaulted beyond 90 days. So the question is defaulting beyond 90 days is one category. But the question clearly is Stage 3 assets would represent those assets which have, which are very close to a default scenario, and whether this uh, you know, whatever relief that they're granted, the default for 61 days, would they be able to repay that after the temporary relief is over? So one has to really make an assessment of whether the borrower has the repayment capacity or the capacity to repay the amounts post relief. If the answer to that is no, then one will have to, actually classify it has stage 3 and will have no options. But if there are enough indications to say that even if it was 60 days overdue, and I know you could, one of the demonstrable areas would be to say that, it has in the past paid almost more than 60 days. As in the Indian context, there could be certain borrowers which pay only after between 60 and 90 days and not beyond it. And if the borrower has a sort of a practice of paying between 60 and 90 days, and there has been no other impact on the business of the borrow, it is just the temporary leave which it has used, then in that case, maybe you need not classify as a stage 3 asset. But I think the guidance across the globe is very clear that just because that a borrower has taken relief, it should not move into the stage 3 category. But other factors will need to be seen before moving it on to the stage 3 category. Uh, the next question that I have is on what specific care should be taken in case of microfinance and BFC. I think when we talk about microfinance, we talk about smaller loans to smaller businessmen, to smaller businesses. And in some cases, it could also happen that the small businesses, if they don't have, their cycle is very small, maybe a 30-day cycle or a 15-day cycle or a 7-day cycle. And if their money doesn't come back in that period of time, they actually have no means to repay that loan, and that would mean that that loans would have to be pretty typically written off. So one will have to actually segment the microfinance loans in such a way to see what has been the impact. One could also pick up some sort of experience from what has happened in a demortgage, because microfinance loans, even there was a sort of a shutdown at those times, and that resulted in some write-offs in some microfinance companies. Maybe that experience can also be considered, though not fully, it is not fully representative of that experience, but some of that experience can also be considered while doing it. But I think in microfinance, what clearly would help is further segmentation of the portfolio into saying the tenure of the loans. The tenure of the loans is less than 30 days, and those loans should be segmented separately and looked at from a perspective of whether there is any recovery possible. In my view, recovery in most of those cases will not be possible, and that loan has to be really stage 3 and 100% LGD. Most of the microfinance loans, I think the LGD is 100% when it crosses, into the stage 2 and stage 3. So one will have to look at the behavior of this loan, the probability of recovery, and consider that, because these are small loans to small borrowers for whom a lockdown beyond a particular point won't help them revive until new funding is given to them. So one will have to look at all that before we, do anything. The next question is the intensity of the assumption, the VCL computation change in between the date of signing of the auditor's report and before the AG of the NBFC. How this is to be managed. I think this is more an audit question. The auditor is responsible to the date he signs of the financial statements, and if there is any change in between that, I think that would tantamount to reopening of the books, and I think that is a legal question. You may want to consider your lawyers in that, consider whether you want to reopen accounts of a previous year or not before the AGM and prepare new accounts. I think there are various case laws on it, and maybe it's more of a legal question than an accounting question for me to answer. But yes, you could have a couple of issues there. But I really don't know whether what the question being asked is really practical, because I don't think in June and August or September there could be such a measure. But let's look into it. You're right. There needs to be a legal opinion taken on this. The last question which I have, and I think I have enough time for that, is in microfinance, borrowers are huge in numbers, but finance amounts borrowers are small. Yeah. So, again, the question of microfinance, I think, let me look at NBFC. NBFCs are, and even let me include HFCs into it. So, and there are NBFCs which do corporate loans. There are NBFCs which do small retail loans, which could be auto, home loans, personal loans, so forth and so on, professional loans, and all this stuff. Then there are the microfinance institutions which do microfinance loans. I think the criteria for all this determination of ECL across this would be different. As I said, for corporate loans, you have to do a top-down approach, review top borrowers, look collective provisions for this. Coming back to the retail loans again, resegmentation would be the key. How do you determine the impacted areas out of the non-impacted areas? And within the impacted areas, how do you determine which cases you may need to move on to stage two, then stage one, and keep the balance on stage one be critical. In microfinance loans, the repaying capacity of the borrower if the business has been shut for a couple of days. I think smaller loans to smaller borrowers would be difficult for recovery, and large provisions could come up in the microfinance portfolio. And that is where it needs to be very keenly observed. That's my two bit on the questions. But thank you so much for being such a nice audience. And this question and answer on ECL will never end. I have actually tried to put down my views, and I'm more than happy to answer any questions. Please feel free to write to me if you have any queries. Happy to get back to you as and when I can. And back to you, Murtuza. Thanks for giving me the opportunity. And thank you so much for being there. You take care. These are testing times. I'm sure we'll come out of it. Thank you. Thank you so much. Murtuza,
Thank you,
off to you.
Charanjit. Yes, thank you, Charanjit. And excellent session, marathon session. And also, I'm happy that you could cover all the questions. And what we'll do is we'll compile the questions if there are any further, and we'll send it to you on mail so that you can have your answers on that. And again, mail it back to WRC. We'll upload on the website as well. So thank you once again. And let me also thank CA Hiral Shah for helping us in setting up this whole webinar when WRC was struggling initially. I should also thank the WRC staff, Ravi Arora ji, Mishra, Subhash, Vaibhav, Seema, for helping us organize these webinars on a daily basis. And I would now request my regional council colleague, CA Manish Gadia ji, to please propose a hearty vote of thanks. Manish bhai, over to you.
Thank you, Murtaja bhai, for giving this opportunity. And we all know that ECL provisioning in case of NBFC has now become very important under the scenario of COVID. So rightly said by Mr. Atra, saying that the higher haircut on the collateral is very important, and determining the macroeconomic scenarios, then ECL disclosure, all these are very important while doing the audit of NBFC. So we all should take care of that. So thank you, Mr. Charanjit Atra, for giving us such a nice and lucid presentation and answering all the questions. And I request all the participants to carry with loud applause at your home. Thank you very much.
Thank you, Manish bhai, for helping us with all the arrangement and infrastructure as well. Thanks a lot. And thank you to everyone. We'll formally close it. Charanjit ji, thank you very much.
Thank you so much. I welcome all.
Sure.